Good afternoon. I'm Paul Mendoza with New York Life Investments, and I want to thank you all for attending this year's virtual Excel 401k Digital Series Conference. And a special thanks for tuning into this presentation and taking the time to continue to sit in front of your monitors to hear our presentation on defined outcome investing. Now, before I go further, a couple of admin points for everybody. Number one, anyone who is interested in obtaining a copy of this presentation afterward, please just include your request in the chat function on the right-hand side of your screen. Let us know you'd like a copy and where we can send it to, and we'll be happy to do so. And then lastly, once the presentation is concluded, please stick around. I know several of you have enrolled in a few cool giveaways, some AirPods for your listening pleasure, as well as some potential free attendee registrations for next year's exciting Excel 401k conference when we're back in front of each other once again. But with that, I'm going to kick this off. And as we thought about what type of presentation to deliver today, we wanted to provide something that was in keeping with the adaptability and creativity that each one of you has had to provide to your clients during these unprecedented times. I know you would all agree that the pandemic, business closures and disruptions, social strife, and now the election have forced each and every one of you as advisors and as consultants to have to provide more outside the box thinking and solutions to your clients than ever before. There's a significant dichotomy that has emerged in the markets this year. On the one hand, a major pandemic remains ongoing. Unemployment rates are high, deflationary pressures are strong, bankruptcies are expected to accelerate, credit conditions are tight by some measures, government support is starting to fade, and all this against a backdrop of a very uncertain election means volatility is extremely high. Now, on the other hand, the stock market is continuing to charge forward, even despite some recent giveback. Not only has the S&P 500 index rallied by about 60% in just 5 months, even with a collapse in earnings, the index is now the most expensive it has been since the technology, media, and telecom bubble of the late 1990s. And it's that chasm between Main Street and Wall Street that has become the source of much confusion and debate in the markets. The equity market bulls say that this mania is justified because the world economy is essentially being redesigned and more tech-centered. However, the bears assert that over 60% of global stock markets are trading in top quartile valuations, including countries that have heavy cyclically weighted equity indices, i.e. non-tech-centric markets. In other words, they argue that everything out there is expensive. So I guess the key question is this: who's right? Are markets mispricing the fundamentals, or are the fundamentals about to significantly improve? And linked to all of that, how will this year's US election result influence whether the US economy enters either an inflationary boom or a deflationary bust? I think the central theme here, though, is that no one really knows for sure. But one thing is for sure, and that is that our clients and participants are desperately searching for things that they can control. It's an outcome that they can both understand as well as define. So, what is defined outcome investing? In its simplest form, defined outcome investing provides market exposure with greater control and limiting losses from severe market pullbacks while enhancing your market upside capture. It also offers a flexible approach that modifies a passive investment's risk-return profile. Now, while there's plenty of stimulus in the markets today, the high levels of uncertainty are a big reason why everyone should be considering such an approach. Essentially, defined outcome investing allows investors to change their risk-return profile of a certain market exposure in order to achieve a predetermined outcome over a predefined investment horizon. This means to your clients that instead of trying to time the market, investors can invest knowing with specificity what their potential for upside or downside participation is relative to the underlying broad market exposure. Now, again, we wanted to provide something that would get you thinking outside the box, maybe where it concerns your cash balance plans or some of your corporate client, your business owners, investment committees, and highly compensated earners. And so I would point to some of these points on the slide and these benefits that defined outcome investing can actually provide. One of which being we're actually able to align our investors' goals with that of a specific investment objective. It can also be tied to what that individual investor or that cash balance plan's market outlook might look for at the time. And as I mentioned, very customizable. We're able to actually select the desired equity market exposure, i.e. domestic or international, even emerging markets, and customize according to a specific risk tolerance or investment time horizon. We can do this all with meeting the liquidity needs of the client. Most important for many, downside protection. We are able to provide predetermined degrees of downside protection ranging from full, partial, or none at all. And lastly, and very important in our industry, is that fiduciary approach. This type of defined outcome investing offers full transparency on fees and holdings with no early redemptions, penalties, or charges. So who might be the ideal target investor? While the individual investor stands out as the obvious client who would most benefit, again, I'd like you to think a little outside the box here and imagine how defined outcome investing of the type I'm about to discuss might benefit your cash balance plan clients as well. Now, before we get into this and unpack some examples of defined outcome investing and the vehicle that we chose to provide it, I want to further discuss why we feel that defined outcome investing makes a lot of sense in today's market. And regardless of what side of the aisle that you sit on, it's really important to understand two key downside risks to both markets and the economy as it's centered around the election. Now, that first risk is actually a short-term one, and it's centered around whether the election results, once announced, will then be contested. The second risk, and arguably perhaps more significant, is tailored around a Biden administration win scenario. I'll give you a teaser, though. Both of these center around extreme market volatility. So if the election result is close, especially among key swing states, the chance that the election results will be contested is very high. And in that instance, it's likely to generate a bout of uncertainty and volatility in the markets. Now, naturally, there's plenty of grounds upon which the results could potentially be contested. We've seen this in the news. We've even heard it in the debates. These include disputes associated with mass postal voting or other potential issues surrounding ballot box voting. Now, whether this is true or not, or whether we believe it or not, the fact of the matter is that perception sometimes becomes reality. And so if this were to happen, Congress's focus would become diverted away from agreeing on new stimulus package. In fact, we've already seen that today. This would occur possibly at a time when more government support is needed and potentially long overdue. Now, in that second scenario, a Biden administration win, we would see that, or we've already seen that he has proposed increasing the corporate tax rate from 21 to 28%. That would largely reverse the Trump corporate tax cuts from 35 to 21%, which at the time of implementation marked a quote unquote permanent improvement in corporate sector cash flow. Now, in addition to that, Biden's proposed plans, if passed, call for deductions for 401k contributions to be replaced by a 26% tax credit. Additionally, capital gains will be taxed as ordinary income for households making above $1 million, as well as the fact that higher tax rates for corporations and household incomes above $400,000 would be enacted if, in fact, this change occurred. So these types of changes, again, in a Biden administration and if enacted, could essentially create greater selling pressure in the markets, i.e. before the tax rules change. And for many investors, higher capital gains taxes raise concerns about the capital mobility and long-term U.S. economic growth outlook. And listen, the long story short here is that the probability of continued or increased market volatility is extremely high, making this a very difficult time to manage risk, whether for an individual, a plan menu, or a cash balance plan portfolio. So, as many of you already know, defined outcome investing is not new. It's been around a long time. But we've looked at a new way of providing this type of defined outcome solution utilizing a unit investment trust, or a UIT, as the vehicle to drive these types of defined outcome solutions. Now, a UIT is an investment vehicle comprised of securities with a scheduled maturity date that offers exposure to an underlying index. And it's a 40 Act registered vehicle like a mutual fund or an ETF, which makes them super simple to use. UITs lend themselves well to defined outcome investment strategies because they have a designated beginning and an end, essentially a maturity date. So think of the positive implications that this can potentially present for your cash balance plan business owners who are looking for a stated exit date for themselves or for their business. Now, unlike other types of defined outcome vehicles, such as structured notes or equity indexed annuities, UITs are much more easily accessible. They provide daily liquidity at NAV with no bid offer spreads or early redemption fees, and they're completely transparent in holdings and fees. They're also not subject to issuer credit risk, which is something that many people who have utilized structured notes for cash balance plans in the past have stated some concern over. Now, as you continue to think about the initial applications of an investment like this, I point out a few important points on this slide. Whether used in the context of a cash balance plan or as a vehicle for business owners or other highly compensated employees, this strategy serves to eliminate concern over credit risk, lack of liquidity, as seen in other vehicles, as I mentioned, like structured notes, as well as being able to do so in an extremely transparent and competitively priced investment. This, combined with excellent tax efficiency, creates an extremely versatile solution for your corporate client needs, whatever those needs might be. So let's examine some of the key differences in utilizing a UIT as the vehicle to facilitate defined outcome investing alongside other well-known types of investments that are looking to essentially offer similar results. One of the most popular vehicles, as I've already mentioned in this space, that being cash balance plans, is structured notes. But as you can see, the challenge here becomes liquidity, holdings, transparency, lack of publicly available NAVs, as well as credit risk. ETFs are also commonly used here, but we have challenges in ETFs in terms of defining a solution outcome by a specific date. And this makes it difficult for business owners to plan exit strategies for themselves and others. Mutual funds share this same type of challenge, along with a longer timeline of disclosing the holdings, which can and do change over time. So reporting here is typically done once a quarter as compared to daily disclosure of the static list of the underlying investments held within the UIT. And that kind of takes me to what's exactly inside this UIT vehicle. I've kind of danced around why we would use a UIT, but what's in it? How are we making this work to be able to provide these defined outcome solutions? Now, the purpose of this presentation isn't to dive deep into the mechanics of it. So broadly speaking, what I will say is we're utilizing ETF options that are tied essentially to an ETF index like SPY in order to create those defined outcome solutions that our investors are looking for. Now, before I run through a couple of different types of investment outcomes that we can actually plan for, I think it's important to understand the typical timeline for the creation of a UIT of this nature. It's also important to mention that we have the capability of customizing to a very large degree the type of outcome we're looking to achieve, as well as the length of time it takes to achieve it. This whole process begins with a preliminary offering period, which lasts up to 30 days. This is when we customize or announce a specific type of solution. We take indications of client interest and provide a preliminary fact sheet to use to provide to your potential investors. We then have our initial offering day, which is when shares of the UIT become available for investment. All terms are set at this point with units issued at $10 each. Now, after the initial offering day, we extend into the primary offering period, which can vary by fund, but typically lasts about 90 days. During this time frame, investors can continue to buy as well as sell units at the daily public offering, which is made available daily via the published quotes. Now, once this time period has elapsed, we enter into the trust life, during which time units can no longer be offered to new investors. However, existing holders can continue to sell units at the daily closing NAV. Now, once the UIT has reached its stated maturity date, the UIT is dissolved and the proceeds of the value of the options assets are paid to the unit holder, settlement occurring 2 days after termination date. So to put that into a context using the cash balance plan example, if the cash balance plan was designed to terminate at the exact time that the UIT would mature, then those funds would simply flow over to the cash balance plan participants. If that cash balance plan continued to move forward, then what we would be doing before that maturity date of the UIT is essentially customizing a new one to replace the initial UIT once it matures, and then those funds would automatically roll into the new customized UIT that generally has, again, a very, very flexible time mandate, generally speaking between 1 and 4 years. So now we're finally at the exciting part, and that's what type of primary outcomes we can deliver. So broadly speaking, we're able to offer 3 different types of strategies, all designed to align to a specific investment goal. Preservation strategies, which provide market exposure with compelling downside protection. There's buffered strategies, also providing market exposure, but with insulation from a specified amount of upfront market loss. And then there are growth strategies, which can provide an enhancement or a kicker to the overall market exposure, but have no downside protection to them. So let's briefly look at some hypothetical examples of each type. Preservation strategies. Now, this type of solution is the one that we typically see as being most suitable to a cash balance plan. This strategy seeks to deliver an ETF's price appreciation up to a capped amount, while partially protecting the initial investment by defining a maximum loss on that investment. So in this example that you're seeing, the SPY ETF options here are serving to provide a 95% capital appreciation that essentially would create, if held to maturity, an investor that would only be limited to experiencing only the first 5% of a hypothetical market loss. So basically, it's 1-to-1 on the downside up to a 5% loss, as you can see in the lower right corner of the slide. Basically, but if they experienced a 20% loss, they would only be limited to that initial first 5% of that 20% loss in price return. Now, conversely, price appreciation would be 1-to-1 on the upside up to a hypothetical cap of, in this particular example, 27%. Now, again, these caps can be further customized to some degree based on the specific requirement. I know no one here wants to see a cash balance plan earn 27%. So what we would do is basically create a customized defined outcome solution where we have a window of returns that would say offer up somewhere around 6 to 7% on the upside and say 5% limited on the downside. Now, the next strategy that we're going to review are the buffered strategy, which are similar to preservation strategies with an important difference. Here, we see a defined outcome investment with a 20% buffer. The buffer insulates the investments from experiencing market loss for the first negative price return of, in this case, 20%. However, if the SPY in this case loses 30%, then the investor will be 1-to-1 on the downside after that first 20% buffer. So in this example on the right, you'll see that they would not experience the first 20% loss, but if there was a total of 30% loss in the SPY, then they would only experience 10%. Conversely, if the SPY returned a price return of negative 20%, that investor would literally suffer zero performance in terms of being down for that particular time period. The last strategy that we'll look at today is most suitable for a bullish investor or one that's looking to enhance any potential short-term gains in the market. The growth strategy in this hypothetical example provides an upside enhancement of up to 18% max with one-to-one downside participation. So in the case of a modestly positive performance of 4% by the SPY, the growth strategy would actually provide a kicker, taking that overall return up to 12%. Now, by contrast, if the SPY delivered negative results, then that investor would experience negative performance on a one-to-one basis in this case. Now, as with all investments, there are inherent risks which are listed here. Now, I would specifically point out that in order to meet the stated strategy objectives, a UIT of this nature needs to be held for the entire term. Again, typically 1 to 4 years. As such, downside protection, if applicable, or the enhanced participation on the upside would only apply at maturity date. And the investor could see different results if they sold early, either better or worse. And as with all investments, there's no guarantee that a liquid secondary trading market will exist for desired options if chose to be sold early. Now, in closing, the purpose of this presentation was to hopefully provide to you some additional tools or thoughts in terms of your toolbox for your corporate plan clients, your business owners, or individuals who are looking for ways to help mitigate the risk and uncertainty of today's investing environment. We believe that when used tactically or strategically within a diversified portfolio, it can be an excellent way of achieving specific investment objectives, whatever those objectives might be. Now, again, if you have further questions, please let us know in your comments, contact me directly, or contact your dedicated New York Life Investments advisor consultant. Thank you so much for your time. Please stay safe, stay healthy. Happy Halloween, and please don't forget to hang out and find out who wins the AirPods and registration for next year. Thanks a lot.
Well, thank you, Paul. And so that was a great presentation. Thank you for being a part of the series. New York Life has been with us for many years with Excel, so we do appreciate that. So at this time, what we're going to do is that we have a wheel that we're going to spin, and we're going to do a couple of different spins. The first one will be for a registration to Wealth at Work. That's what Excel 401k is being rebranded in Nashville at 21. So this was for complimentary registration. So Brian, go ahead and spin. All right, that is Rick Snowden. So Rick Snowden, you got a free pass for next year's Wealth at Work conference at the Grand Hyatt in Nashville, Tennessee on Broadway, right by the Honky Tonks. All right, we have one more registration we'll do. Go ahead and spin. All right, Snowden, Snowden, play Powerball today. All right, here we go. That is Hayes. Greg Hayes is the other registration. One more. There's one more. Look at that. The prizes keep coming. We have one more to do. So Greg Hayes has one. Our final registration for next year. All right, one more time. There we go. All right, that is Becker. Brian Becker has our final registration for Wealth at Work next year at the Grand Hyatt in Nashville. And then our final spin today is going to be for the AirPods Pro. We'll contact you on that if you win, and make sure we have all of your shipping information and come directly from Amazon. So our final spin today for the AirPods Pro. What?
O'Sullivan.
O'Sullivan. So that is Parker O'Sullivan has won the AirPods Pro. So we will contact you directly, Parker, and get all of your information and make sure I have it correct so we can ship those to you directly from Amazon. Thank you, everybody, for participating. And we look forward to seeing you guys on more sessions and definitely at Wealth and Work next year in Nashville at the Grand Hyatt. And Paul, thank you so much today for your presentation and for your partnership with us.